Welcome to the deep dive. Today, we're really getting into private wealth management. We've got a whole stack of material here. Covers everything, history, business models, who does what, regulations,
Yeah,
the works. Our mission, to boil it all down for you, get you the core insights you need to really understand this big piece of the financial world beyond just the headlines.
exactly. It's quite a world, isn't it? Goes way back, centuries old Swiss banks, right up to these slick digital platforms we see now. And what's really interesting, I think, isn't just what they do, but how they do it. The relationships they build with these, high net worth, ultra high net worth clients. And of course, the regulations they operate under now, much tighter.
Okay, before we get too deep, let's just pin down some terms. We hear private wealth. That's basically the money of wealthy people, families who need special financial help, right?
Right. Financial assets needing guidance.
And wealth management or private wealth management, often used the same way.
Pretty much interchangeable, yes.
Then there's private banking. That sounds a bit more bespoke, like really personal service for the very wealthy. Covers investments, tax, estate planning, plus regular banking stuff.
That's generally the implication, yeah. More holistic. And asset management or portfolio management, that's more focused, isn't it? Just on managing the investments themselves.
Got it. And the people doing this: wealth manager, advisor, private banker, client advisor, wealth advisor, all basically the professionals guiding the clients.
Generally, yes. Different titles, similar roles in guiding clients through financial complexities.
Okay, so let's talk history. This industry wasn't always this huge, global, regulated thing we see today, was it?
Oh, not at all. I mean, the roots go way back, but the modern shape really started forming after World War II. You saw private banks starting to go international, setting up shop in key financial centers, and a lot of that growth was driven by global trade picking up and the rise of these offshore financial centers, OFCs. They offered, well, asset protection, tax planning advantages.
Right, those places with the promise of, let's say, discretion and maybe lower taxes. And then later in the 20th century, globalization kicks into high gear, emerging markets take off. Yeah. That really boosted the industry, didn't it?
Massively. But that rapid growth sometimes outpaced, let's say, the focus on strong ethical standards.
Ah, okay. That makes sense. So that kind of rapid expansion, it highlighted the need for more transparency, better ethics.
Exactly. It really set the scene for the big regulatory changes we've seen since. You had early things like Sarbanes-Oxley, MiFID, trying to bring more transparency. But the real game changer, the big catalyst, was the 2008 global financial crisis.
Ah, yes, 2008. That shook everything up. So how did that hit private wealth management specifically?
Well, 2008 wasn't just a market crash, was it? It fundamentally damaged trust. People lost faith in unchecked finance, so regulators had to step up, prioritize transparency, client protection. It really changed the whole dynamic. In the U.S., you got Dodd-Frank. Europe brought in MiFID TEF. And globally, the Financial Stability Board pushed for much tighter supervision, more transparency. Banks, non-banks, everyone. A real turning point.
Speaking of foundations, that brings us to Swiss banking secrecy. Our sources mentioned that. It was legendary, wasn't it? For centuries, Switzerland was secrecy. You had giants like Wageland & Co., Lombard Odier, Pictet, but that's changed dramatically now.
Completely. Banking secrecy was, deeply ingrained, especially after their 1934 Act. But today, very strict legal limits. The pressure after 2008 was immense. And then in 2014, Switzerland signed up to the OECD's Common Reporting Standard, the CRS. That was huge, basically aligning with global transparency standards, pushed by groups like FATF. So that old image of absolute secrecy, mostly gone. Transparency is the norm now.
It's fascinating how all these different factors, demographics, where people live, culture, market trends, all shape this industry. Even things like a country's healthcare system or retirement benefits seem to play a role in what people need from wealth managers.
Absolutely. Take the U.S. market. It's generally seen as quite fragmented, right? Partly because government retirement and healthcare aren't always seen as covering everything. So you get lots of different managers offering investment, insurance, savings products. Compare that to, say, continental Europe, France, Italy, Spain. It's more oligopolistic there, dominated by big banks. And that's partly linked to stronger defined benefit pension plans, public health care. People might feel they need less private provision. The UK, many Asian countries, they tend to be more diverse again.
Okay, let's clarify onshore versus offshore. We hear those terms a lot. What's the difference for our listener?
Sure. Onshore just means financial services provided within the client's home country, where they pay taxes. Offshore means services offered outside that home country or regulatory zone. Why go offshore? Well, maybe seeking political stability elsewhere, better legal systems perhaps, tax incentives sometimes, access to unique investments, or sometimes, frankly, a lack of trust in their own local system. Singapore's a big offshore hub in Asia, for example.
And it's not just about location, is it? That there's a difference between offshore centers and cross-border financial centers.
Good point. Yes. Cross-border centers like the US, UK, Switzerland, they serve both their own domestic clients and international clients. Offshore centers, think Isle of Man maybe, they primarily focus on clients living outside their jurisdiction. Exhibit 1 in our materials actually lists the big cross-border players from 2021. Switzerland, Hong Kong, Singapore were leading by wealth managed. Shows where the money comes from, too.
That's helpful context. And Exhibit 2 mentions specialized centers. Luxembourg for funds and insurance, Delaware for companies, Cayman Islands for hedge funds. Quite the ecosystem. It even shows OECD transparency ratings. Compliant, largely compliant, etc. That helps you figure out how transparent these places actually are with tax info.
Exactly. Those ratings are key for understanding the regulatory climate.
So who are the actual players doing the work in this industry? It's not just one type of company, is it?
Oh, definitely not. It's a real mix. You've got your huge universal banks, where wealth management is just one part of their global business. Then local banks, trust departments, they might focus on retail banking or specifically wealth management. Private banks and trust companies, their main game is wealth management. Investment banks are a bit different. Higher entry point, usually serving the ultra-wealthy with complex stuff like M&A advice, capital raising, more institutional type services. Then you've got the newer digital and direct banks, often for smaller clients, automated advice, lower cost. Brokerage firms act as go-betweens, but the bigger ones offer more investment management too. Asset managers, fund managers, they're really focused on the investment side, creating the portfolio building blocks. And don't forget, independent advisors, financial planners, wealth advisors, external asset managers, they operate on their own. Plus family offices, single or multifamily, handling a huge range of financial, admin, even lifestyle stuff for wealthy families.
Wow, okay. A really diverse crowd, different strengths, different models. Let's shift gears to strategy. The reading brings up Porter's 5 forces to understand competition here. Can you break that down?
Sure. So first, threat of new entrants. It's actually quite high, barriers-wise. Lots of regulation, and trust and reputation are huge. Hard for newcomers. Though you do see family offices popping up and robo-advisors finding niches. Bargaining power of buyers, the clients, it varies. Ultra-high net worth clients, they have the most clout. Big money, lots of alternatives. Bargaining power of suppliers like tech providers or specialist advisors. Generally less power unless they have really unique expertise. Threat of substitutes, things like DIY investment platforms, robo-advisors again. And finally, competitive rivalry. It's intense. Firms compete hard, mainly on service quality and personalization.
Okay, so those forces really shape how firms decide to operate. What key factors drive those strategic choices?
Oh, several things. A firm's own skills, its reputation, which is massive in this business. Its financial muscle, can it afford the tech? Who are its target clients? How sophisticated is the market? What are the regulations like where it wants to operate? Does it have a good distribution network? Does it need physical branches? Lots to consider.
And that onshore versus offshore decision, plus deciding whether to set up shop locally in other countries,
Yeah.
that seems like a really big strategic call for firms wanting to grow internationally.
It's huge. You have to deal with different rules everywhere, different client cultures, different professional standards, different needs. Imagine a U.S. firm expanding to Switzerland. They have to think about Swiss secrecy rules, even the modern ones, local investor risk appetite, what assets Swiss clients typically hold, and do they need branches? Or can they operate remotely, given the Swiss preference for privacy and maybe face-to-face contact?
It really highlights how crucial understanding the local scene is. Legal, cultural, everything if you want to go global. And technology, obviously, is playing a bigger and bigger role, both in finding clients and managing them, right? Even if firms rely on it to different degrees.
Absolutely. Referrals and personal connections are still vital for getting new clients, but tech is increasingly woven into managing those relationships day to day. How much automation a firm uses often depends on who they're targeting, the wealth level of their clients.
Let's talk about the client lifecycle. Acquisition, development, retention. Sounds basic, but what are the key strategies here for wealth firms?
Okay. Acquisition, getting new clients. Cost effectively, ideally. Often relies heavily on referrals from happy clients, working with lawyers, accountants. Marketing, digital stuff too. Development, deepening the relationship you already have. Getting clients to use more services, trust you with more of their assets. cross-selling, upselling, and retention, keeping clients long-term. That's about building trust, good communication, anticipating their needs as circumstances change, adapting your service, being proactive.
Exhibit 3 gives a nice visual of that cycle. Now, implementing strategy. The reading talks about Porter's main approaches. Cost leadership, differentiation, focus niche. How do those play out here?
Right. Cost leadership, that's usually aiming for a broad market, using scale, offering cheaper products, maybe automated platforms. Think big universal banks, some specialized players. Differentiation, targeting the higher net worth, affluent clients, offering something unique, high value. Comprehensive planning, exclusive investments, aiming for better margins. Focus or niche, zeroing in on specific segments, maybe particular types of HNW clients, certain regions or markets. Highly personalized service, premium pricing often follows.
The firms can mix these, can't they? The case study on Pi R-squared investors, PRS, is interesting. Newer firm, using relationships for specialized alternative investments, but also partnering for cost-effective operations. Sounds like they're aiming for better risk-adjusted returns, more personal touch, maybe justifying higher fees than a pure cost leader.
Exactly. They're not just competing on price. Their difference is that access to unique stuff and the tailored service.
Okay, so how do firms usually group their clients? Wealth-based segmentation seems to be the main way.
Yeah, that's the most common. You see categories like retail, affluent, H&W, high net worth, UHNW, ultra high net worth, usually based on rough ranges of investable assets. Retail, minimal dedicated service, basic savings, maybe ETFs, index funds. Affluent, some basic financial planning, maybe tax help, often using digital tools, standard products. HNW, more complex needs, longer horizons, need help with wealth transfer, maybe get tailored solutions, exclusive products. UHNW, super complex, often needs a whole team, internal, external advisors, diverse assets, liquid, illiquid. Senior management from the firm often gets involved.
The reading even gives some general US dollar figures for HNW, UHNW thresholds, but it also says this method has flaws.
It does. Clients might not want to reveal all their wealth, and just knowing the amount doesn't tell you everything about their situation, their goals. But despite those issues, it's still the main way the industry segments clients.
Let's move on to the actual services. What are the core things you'd expect from a wealth management firm?
Okay, the basics: managing deposits, handling liquidity and payments, client reporting for tax, regulatory reasons, general account admin. Then, lending, mortgages, credit cards, Lombard loans where you borrow against your investments, sometimes specialized loans for things like planes or art. Brokerage, just executing trades. Asset management, that's the portfolio management piece. Discretionary or advisory mandates. Asset allocation advice, providing investment products. Wealth planning and advice. Structuring assets, legal tax guidance, estate planning, retirement planning, philanthropy advice, big area. And finally, insurance and wealth protection. Things like life insurance, trusts, fiduciary services.
Pretty comprehensive list. The example of Swiss external asset managers, the EAMs, is interesting. These independent guys seem successful by being nimble, personal, focusing on HNW, HNW, even inspiring copycats in places like Singapore.
Right, their independence is key. They can be very focused on individual client needs, maybe offer access to niche markets or expertise that bigger firms don't prioritize.
Okay, let's get into fees and compensation. Crucial topic. The reading says fees are generally higher here than in retail banking. And transparency seems like a big deal now. Regulations pushing for more disclosure.
Yeah, definitely a trend towards more transparency, partly pushed by newer online players who are often very upfront about fees, can make some traditional firms look a bit opaque sometimes. How much revenue a firm makes depends on lots of things: its business model, licenses, size, location, how experienced and efficient its people are.
And how is that revenue broken down usually?
Mostly into recurring revenue, ongoing fees for managing portfolios, using funds, custody, regular advice like tax planning, and non-recurring fees for specific events like a big transaction or special projects. The fees themselves can be fixed, like a set annual charge, or variable based on transactions, or a percentage of assets under management, AUM. Often it's a mix of both.
What about external factors? Things outside the firm that affect revenues?
Several big ones. Global markets getting more connected means more investment options, but also more sensitive to global shocks, geopolitics. Private markets growing good for diversification, potentially higher returns, but you have liquidity issues, valuation challenges. Technology adoption could lower costs for clients, maybe squeezing industry revenues, or maybe it brings in lots of new, smaller investors, boosting revenues, bit of both probably. And ESG, environmental, social, governance investing. Clients expect it more, but it adds costs. Can firms pass those on? If not, it might squeeze margins.
Sounds like a tough competitive environment pushed by these trends. The examples from the UK, RDR, and FAMR and MiFID in Europe, they really show that regulatory push for clearer fees, less commission-driven advice, right?
Absolutely. Those rules were about raising standards, reducing conflicts of interest, making advice more accessible and affordable too, often by encouraging tech-based solutions and clear fee structures.
What about internal levers? How can firms try to grow revenue themselves?
Four main ways discussed. One, boost portfolio returns, but that's hard to control, depends on markets. Two, raise fees tricky in a competitive market, may be possible for really unique services or discretionary accounts. Three, get new clients focused on the right segments. Track how much it costs to acquire them. Four, keep the clients you have. Retention is crucial. Minimizes lost AUM and revenue. Happy clients also refer new business. That's where metrics like net new money, NNM, and net new business volume, NNBV, come in tracking growth.
So firms need smart pricing strategies. What makes a good one in this industry?
Well, they need to think about how price-sensitive clients are. Be clear about what's recurring, what's not. Fixed versus variable. Are fees bundled or listed separately? Direct fees or embedded in products? Consistency is usually important. Exceptions should be rare and justified. And, crucially, legal transparency. You have to disclose all the fees clearly in most places.
The example of LPL Financial using white label products raises that transparency point again, doesn't it? The end client might not easily see all the underlying costs, really highlights the need for strong ethics.
It really does. And Exhibit 4 lists all the different fee types you might see. Asset-based, transaction-based, interest on loans, service fees, fees for extra stuff. It's complex.
It is. And the reading warns about churning excessive trading just to generate commissions for the firm, not helping the client. What are the warning signs for that?
Things like unusually high trading frequency, buying and selling the same things, repeatedly watch out for wash sales, too, fees that seem way too high for the account size or strategy. Unauthorized trades are a huge red flag, and maybe excessive cross-selling of products if the firm pushes that hard. But firms are supposed to monitor for this stuff, but clients should definitely check their statements regularly, too.
Another practice mentioned is payment for order flow, or PFOF. Controversial, but what is it basically?
It's where brokers get paid by market makers for sending client orders their way. Supporters say it helps keep trading costs low, enables commission-free trading for retail investors. Critics worry about conflicts of interest. Is the client really getting the best execution price, or is the broker just sending the order where they get paid?
And getting new business can also involve referral fees and retrocessions. Can you explain those and the rules around them?
Sure. Referral fees are for bringing in new clients. Retrocessions are typically payments back to an advisor, maybe from a fund company, for recommending their fund. Now, these can encourage advisors to offer more choices, but they also create obvious conflicts of interest, and they can hide the true cost for the investor. Rules vary wildly. UK, Australia, mostly banned or heavily restricted. US, Canada, generally allowed if disclosed. Switzerland, parts of Asia, Latin America, still quite common. Best practice, ethically. Full transparency to the client about any such payments, always.
Okay, last part of this section. How do the wealth managers themselves get paid? It seems like a lot influences that.
Absolutely. Pay structures depend on the firm's structure, size, global reach, business model complexity, and overall financial performance, especially net revenue. Packages usually have a mix. Fixed salary, variable bonus, cash deferred, equity maybe long-term incentives like stock options with vesting, plus fringe benefits insurance, retirement plans. The exact mix depends on the person's role, experience, performance.
And even within those, there are drivers. Fixed pay depends on role, experience, network, size of portfolio managed, client retention, bringing in new business.
Right, and the variable bonus often tied to firm performance, department results, and individual metrics, like how profitable were their discretionary accounts, how much net new business did they bring in, long-term incentives like equity, mostly about keeping people around. Fringe benefits can be wide-ranging, too. Insurance, pensions, maybe better mortgage rates, training budgets, awards. But, and this is critical no matter how they're paid, the manager's core duty is impartiality, transparency, and sticking to ethical codes like the CFA standards. Client interest first. Always.
Precisely. The client's best interest has to be paramount. Okay, that covers a lot on services and fees. This has been a really packed deep dive so far, but we're not done yet. Next up, we'll look at the other key advisors who work alongside wealth managers, lawyers, tax experts, custodians, insurance folks. Stay with us. Welcome back to the deep dive. We're now looking at the wider network of professionals involved in private wealth management. It's not just the wealth manager, is it? Our sources really emphasize that as wealth gets more complex, the need for specialized advice just keeps growing. A Deloitte survey actually pointed to tailored advice and value-added services as top trends.
That's right. Wealthy clients aren't just looking for standard products anymore. They need solutions really customized to their unique, often very complicated situations. And that often means bringing in other experts, people with skills beyond what the main wealth manager might have. Exhibit 7 gives a good visual of this ecosystem. You see custodians, insurance specialists, wealth planners like lawyers and tax advisors, accountants, even people helping with property or healthcare. It's a team effort.
Let's start with those wealth planners. Lawyers seem crucial for things like estate planning, setting up trusts, drafting wills, making sure assets are protected and passed on smoothly, and dealing with legal documents, maybe even family disputes.
Exactly. And as wealth gets more global, you also need specialists in things like moving countries, expatriation, relocation, immigration lawyers dealing with golden visas. They guide clients through those residency by investment programs, handle the complex paperwork, negotiate with governments. Exhibit 8 shows some examples from 2021. Due diligence is absolutely vital there, of course.
Then tax advisors. Absolutely essential, I imagine, for minimizing tax impact legally, ensuring compliance, using strategies like income splitting or tax-efficient funds. They deal with complex structures too, like family-limited partnerships or offshore trusts.
Indispensable. You can't have effective long-term wealth management without a solid tax strategy working hand in hand with the investment plan.
The reading also mentions specialized personal banking services for wealthy clients who travel a lot or own property overseas, multi-currency accounts, financing for foreign properties, and commercial banking for entrepreneurs or family businesses, special accounts, loans, treasury management.
And don't forget investment banking. For wealthy individuals who own businesses, investment bankers offer strategic advice on M&A, raising capital via private equity or VC, planning exit strategies like IPOs. That's often a level of strategic business advice that a typical wealth manager might not provide directly.
And accountants, of course. The bedrock for keeping financial records straight, compliance, financial planning, cash flow management, budgeting.
Beyond those core advisors, you also have other niche consultants. Educational consultants helping plan for tuition costs with trusts or savings plans, philanthropic advisors guiding charitable giving, even specialized asset managers focusing on things like fine art or collectibles. They need deep market knowledge connections.
Now, custodians, they work behind the scenes mostly, but their role sounds fundamental.
Absolutely critical. They're the ones safely holding the client's assets, making sure they're segregated, not mixed with the custodian's own money. They handle transaction processing, record keeping, and increasingly provide sophisticated performance reporting and analytics. That data helps the wealth manager track performance, refine strategy. And as clients become more global, the custodian's expertise in handling different markets is key.
So choosing the right custodian is a big deal. The reading stresses things like accurate data, good reporting, 204/7 access, investing in technology.
All vital. A good custodian provides security, yes, but also the data infrastructure that supports smart decision-making.
Then there are insurance specialists. Seems insurance here isn't just about risk anymore. Some products are investment vehicles too.
That's right. Things like private placement life insurance, PPLI, combined insurance with investment opportunities, often with tax benefits for the wealthy. Then you have specialized insurance for liabilities, umbrella policies covering more than standard ones, or for high-value assets like art, collectibles, properties, even really unique risks like kidnap and ransom insurance. That often involves working with security consultants too.
Interesting how the insurance portfolio can affect investment strategy. Like, if you have less coverage, you might need more liquid investments.
Exactly. The insurance choices tell you something about the client's risk tolerance and needs. Investment and insurance planning should really go together.
Our sources also mention support professionals for non-financial needs, health consultants, property managers, lifestyle managers, educational consultants, admin support. It paints a very holistic picture.
It does. Good wealth managers work with these people to get a full view of the client's life, their goals, their needs. What a property manager finds affects the budget. What a healthcare consultant advises affects insurance planning. It's all connected.
The case study about Emily in the unstable country really shows this multidisciplinary approach in action. The private bank coordinated with insurance specialists, kidnap, political risk, immigration lawyers, golden visas, tax advisors, a whole team to give the family security and options.
Perfect example. It shows how bringing different experts together solves complex, real-world problems for these clients.
So how do wealth managers actually manage this network of advisors? Must be challenging to coordinate everyone.
It depends on the firm. Big global banks might have a lot of this expertise in-house. Boutique firms or independent advisors probably rely more on external partners. Family offices are specifically set up to manage this, using internal staff and external specialists. But whatever the setup, the wealth manager often acts as the conductor, the orchestrator, making sure all the advice fits together, aligns with the client's main goals.
It's about making sure all the pieces serve the client's bigger picture. Okay, fascinating stuff. In our final segment, we'll tackle the crucial world of global regulations and ethics in this industry. Welcome back to the deep dive. For our final segment, we're digging into global regulations and ethical standards in private wealth management. Really critical stuff. Our sources stress the link between ethics, laws, regulations, compliance, key focus for the CFA exams too, of course.
Absolutely. Regulating wealth advisors is complex and always evolving. You've got licensing, registration, disclosure rules, fiduciary duties, supervision, enforcement, plus international cooperation is growing. And advisors working across borders, they have to navigate a real patchwork of different legal systems. It's definitely gotten tougher for asset managers serving H&W and UH&W clients lately.
Historically, this industry was known for privacy, confidentiality,
Right.
sometimes romanticized, right? But while confidentiality is important, that focus also, unfortunately, sometimes shielded illegal stuff, like tax evasion, money laundering.
That's the critical point. Money laundering is a huge global concern, and private banking has vulnerabilities. The close banker-client relationship can sometimes lead to overlooking red flags. Powerful clients, including PEPs, politically exposed persons, can exert influence. There's that historical culture of secrecy, sometimes using complex structures like shell companies or trusts, and intense competition, high profits. Sometimes that might disincentivize really rigorous anti-money laundering checks.
Exhibit 9 is quite a wake-up call, isn't it? Listing all those financial crises and scandals, Asian crisis, 9/11 financing, Riggs Bank, the 2008 crisis, Madoff, 1MDB, Panama Papers, Paradise Papers, Danske Bank, Pandora Papers. Wow. Each one seems to have exposed weaknesses and pushed regulators to act.
Exactly. Regulatory change often follows scandals, and international bodies play a huge role in setting standards and pushing for cooperation. You have the OECD setting tax transparency standards, pushing the CRS for automatic info exchange, similar to the US FTICA. FATF, the Financial Action Task Force, focuses on fighting financial crime, setting AML, anti-money laundering, and CTF, counter-terrorist financing standards, customer due diligence, monitoring, reporting. IOSCO brings securities regulators together globally, promoting investor protection, fair markets, reducing systemic risk. And the Basel Committee sets banking standards, capital adequacy, liquidity, risk management.
And getting governments to actually adopt and enforce these international standards is key, right? So for advisors today, knowing the rules in every jurisdiction they touch is non-negotiable. And know your customer, KYC, is more important than ever with these complex laws.
Absolutely. Understanding the global regulatory map is just part of the job now.
Let's bring in ethics, specifically the CFA Institute and its Asset Manager Code, the AMC. CFA Institute is all about ethics, education, excellence. The main code and standards are mandatory for charter holders and candidates. The AMC is voluntary for firms, including private wealth managers. So why is adopting it important?
Well, the AMC sets a high ethical bar specifically for asset management firms. Adopting it is a public statement. We're committed to ethics, to putting clients first. Its core principles are about acting professionally, ethically, for the client's benefit, being independent, objective, skilled, diligent, communicating clearly, upholding market rules. It then details responsibilities in 6 areas: loyalty to clients, investment process, trading, risk management and compliance, performance and valuation, and disclosures. And importantly, while it's voluntary, what the AMC requires often lines up very closely with laws and regulations in developed countries anyway. Ignoring these principles is risky for clients, firms, reputations.
It's interesting how the AMC principles mirror specific laws, like loyalty to clients, putting their interests first, that echoes fiduciary duty rules of the U.S. Investment Advisors Act, EU MiFID II, Australia's FOFA best interest duty.
Exactly. And client confidentiality in the AMC, that's backed up by laws like Gramm-Leach-Bliley in the US, GDPR in the EU, PDPA in Singapore.
What about the investment process? AMC says use reasonable care, have a basis for decisions. Sounds like the SEC's Reg BI care obligation, MiFID 2-second suitability rules.
Very similar principles. And the AMC's ban on market manipulation, that lines up with laws everywhere.
Trading, too. AMC forbids using material non-public info insider trading, just like SEC rules, UK market abuse regs, etc., prioritizing client trades, managing soft dollars or inducements properly, best execution, fair allocation. All these AMC points have regulatory backing in various places.
Yes, MiFID II, U.S. rules, CFA's own soft dollar standards. They cover these areas.
Risk management and compliance. AMC requires policies, a compliance officer, record keeping, business continuity plans, risk management processes. Again, these seem like standard regulatory requirements now under things like the USIA Act, MiFID II, rules in Singapore, Malaysia.
They are fundamental requirements in well-regulated markets, yes.
Performance and valuation. AMC stresses fairness, accuracy, using fair market prices. That aligns with GPS standards, though they're voluntary, and statutory reporting rules. And disclosures. AMC demands extensive, clear communication on everything: conflicts, fees, performance, risks, voting policies, audits, changes. This reflects that global push for transparency we talked about.
Absolutely. Especially with complex products or in the private fund space, regulators worldwide are demanding more and more disclosure, much like the AMC advocates.
So the AMC, even though voluntary, really encapsulates best practice and aligns with a lot of the hard law out there. Following it isn't just nice to have, it's good risk management and helps navigate the legal maze.
Precisely. It's about building trust and operating sustainably in this complex environment.
Well, this has been an incredibly comprehensive deep dive into private wealth management. We've covered its history, the players, strategies, clients, fees, the crucial role of other advisors, and this increasingly volatile layer of regulation and ethics, including the AMC.
What really strikes me is just how complex it all is and how much it's changed, especially with the regulatory pressure and the drive for transparency. It's a dynamic field, constantly balancing tradition, technology, and global oversight.
For me, I think realizing just how many different specialists are needed to truly serve wealthy clients was eye-opening. It's far more than just investment advice. It's a real team effort. And that massive shift away from absolute banking secrecy towards global transparency, that's a fundamental change.
And for you, our listener, we really hope this deep dive delivered what you were looking for, a solid understanding of this field, quickly but thoroughly, without feeling too bogged down. We tried to pull out the key pieces and connect the dots for you.
So our final thought for you to chew on. Looking ahead at this evolving landscape, what do you think are the biggest challenges and opportunities coming down the pike? For both the clients and the firms serving them, definitely something to think about. Thanks so much for joining us for this deep dive.